Welcome to the Pooled Employer Plan presentation. Pretty excited to have this put together. I have an excellent panel of experts. And we're going to be discussing quite a few things regarding the retirement plan market and some exciting innovations and legislation that's going to solve a lot of our current problems. So what you're going to learn on the call today is just to kind of get a state of the current retirement savings here in the US. It's pretty dismal. I'll highlight some of the numbers there, and you'll see why there's a need for these products and this legislation. I'll explain, from my point of view, why that savings rate is so low, what can be done about it, and then the convergence of the future technology, innovation, and legislation, and where that's going to take us. So I'm Eric Monroe. I'm an employee benefits consultant. I've been in the financial services industry for over 30 years. My practice is developed mostly around business owners and supporting them with their benefits practice, which gives me the opportunity not only to take my expertise and help them personally with their business goals, but also to translate that to each individual employee and participant, and being able to help them with their individual goals. So it's nice to be able to offer that expertise and information to a large population of people, from young people accumulating to people mid in their career that are juggling a lot of different priorities, to those that are entering into the decumulation phase, where they're going to start taking income from their investments and try to enjoy their retirement as much as possible. So I've known that there's been a pretty low savings rate for a long time, just from my experience and expertise and exposure to the market. So I've really made it a priority and pretty much a mission at this point, because of the crisis that we're in, to help people save as much as possible for retirement. The stats out there are that Social Security, as it is today, and who knows what it'll look like in the future, that's going to replace about 40% of your working year's income. So most people are not going to be happy or be able to live on 40% of their current income, and certainly not enjoy their retirement. So, the remainder of the gap there is really the responsibility of the individual participant. The days of the defined benefit plan, where you're going to work for a company for 30, 40 years, and then they're going to give you a check every month, even though you're not working in retirement, those days, for the most part, are gone. So those are the old defined benefit days. Now it's really defined contribution, and oftentimes that's voluntary and not something that's forced. So it's really an education, an opportunity, and an education gap that is really keeping us in this low savings rate environment. So according to the Economic Policy Institute's study in December of 2019, nearly 50% of all families have no retirement savings, zero. It's hard to believe that, but no retirement savings at all. The mean for the family right now is $7,800, and that was in 2016. So it's less than $8,000. And believe it or not, that number is below from 2001. So in 2001, you had a little over 8,000 as a family mean. We had some good years after the 01 crisis, and in 2007, before the 08-09 crisis, the Great Recession, the average mean, or the mean family balance for retirement savings was about $11,500. So from 07 to 16, that was cut from 11.5 down to about 7,800 or $8,000. So that's a 30-ish% decrease, and less than 2001. So we've really had a lost decade of retirement savings. I would say there's a few reasons for that, but I would argue, from my point of view, that the biggest reason is that half of all small business owners do not even offer a retirement plan. So there really isn't even an opportunity for employees to pay themselves first and take money out of their paycheck and put it into a retirement plan through their employer, because they don't have that opportunity. And so, my research and just talking to business owners and what I've read, there's a reason for that. And the reason, there are really 3 or 4 main reasons that employers do not offer a retirement plan. And we're talking about, the biggest employer group in the country, small business. The main reasons why are the cost to set up and administer a plan, the time it takes for them at the company to do all the things that you have to do to run the plan, the liability that the owner does not want to take on because that's not their expertise. Their expertise is running their business. It is not being a retirement plan expert or a compliance officer. And that's really the third, is really the expertise. So there's a fear there of not having the expertise and in turn creating a liability. So if you look at just the cost part to start with, in my world, so I work inside of a third-party administrator. We do custom design retirement plans. We do the annual administration. We do the compliance testing. And we help to guide the plan sponsor or the employer through the beginning and throughout the phase of them sponsoring a retirement plan. But all of that, expertise and custom design work and everything, that can be quite expensive for a startup plan. The employer's looking at least $3,000 to $5,000, sometimes a little bit more depending on what kind of plan design they want, just to start the plan. They're looking at writing a $3,000 to $5,000 check. And then after that, the annual administration could run on average, around $2,000. Now, maybe they can get these a little bit less, but I think the point is that if you're a small business and you want to spend $5,000, $6,000, $7,000, and there is a cost to spend $5,000, $6,000, $7,000, that's a major deterrent for you to even consider starting a plan in addition to the other concerns. So let's say you decide to move forward and you write that check. Then there's the time that you or somebody in your company spends in order to manage the plan. You're talking to plan participants. They want to increase their deferrals. They want to decrease their deferrals. They want to take loans. They want to take withdrawals. You have to track their eligibility. When are they able to come into the plan? You have to track that. Beneficiary designations, coordinating with payroll, year-end data collection, annual reviews, housing participant data, 5,500 forms. It becomes pretty time consuming. And that's just time taken away from other operations that your business might benefit more from. So the time it spends to run a plan is obviously a major deterrent as well. And then there's always the liability. What risk am I taking on as an employer by doing this for my employees? I become a fiduciary, and with that fiduciary comes a lot of responsibility. I have to know and feel comfortable with the investment options in the plan. How do the fees compare to my peers? Am I being charged too much? Am I being charged too little? Is there value in what I'm being charged? I have to distribute all these notices by certain dates every year. And if I don't, that could be an issue. I have to deposit deferrals on a regular basis. And again, housing participant data and making sure that that's safe is another issue. And these small business owners don't necessarily have the bandwidth to do everything or the commitment to reduce that liability. So being an expert, if you're in a construction field, the last thing you want to do is become an expert in the 401k business. So those are the major deterrents that keep businesses from opening plans in general. And then now you can imagine with COVID, imagine doing everything that I just mentioned, but doing it remotely. So that's another layer of complexity, and with that comes potential liability. So you can imagine why business owners might shy away from that. You might ask, well, there's usually some advisors around you. My experience most of the time, we're a little bit different, but most of the time those advisors are really focused on the assets in the plan, and they are not very knowledgeable about the plan document, the plan provisions, compliance procedures, making sure that everything that you're doing is being done correctly. Do you, if you get a surprise audit from the DOL, they're going to ask you, show me your procedure for handing out this fee notice to your employees, and how did you do it, and how do you, confirm that they got it? Little things like that are really not within the purview of the advisor. And the third-party administrator that's doing the annual testing, they only look at the plan once a year. So if something was being done wrong all year long, you're not going to know it as the plan sponsor, the employer, until a year, maybe a year and a half later. And that causes, some major issues. So, it sounds like a dire situation, and it kind of is from, a savings rate point of view, but there are solutions, right? So with that said, if we all agree that having access to retirement plan at work is a crucial step to increasing retirement security for more people, we have to address the reasons why that hasn't happened yet. The cost, the time it takes, the liability, and the perceived expertise from the plan sponsor. So there are solutions, and there are incentives right now for employers that want to sponsor a new retirement plan. And these solutions definitely are low cost. Most of the fiduciary liability that I mentioned before about keeping track of eligibility and sending out notices, dealing with deposits, and all the interaction with the employees can be transferred to a third party. And that third party is going to assume the administrative responsibilities as well as the liability for managing the investment menu and all the internal administrative roles. So, we have an opportunity to reduce the costs so that it is not a barrier for entry, and to remove the liability and expertise that's needed or exposed to and is needed to sponsor a retirement plan, and the time that it takes. And all that can be done right now at a much different level than what a lot of employers and advisors, accountants, CPAs, CFOs, HR executives, really understand that there are options out there. In addition to the plan design options and resources, there are now substantial tax credits available that will help employers defer the cost of starting up a plan. So with even better access to plans and credits, the industry as a whole is still pretty slow, kind of cumbersome, and antiquated. And so I really think we're entering into a new era where new technology and innovation is going to take the time to set up a new plan. It could be right now, 2 to 3 months, and you'll learn how the future is going to boil that down to setting up a plan and starting to make deferrals within 30 minutes. Pretty amazing. And where a company can afford to start a plan and not worry about the cost, and certainly not worry about sponsoring a plan distracting them from their business. So it'd be great, start a plan and move on, and review the plan once a year and make sure that everything is working appropriately, and do the benchmarking and get RFPs to make sure that there are not better options for you. And do that once a year, so you can spend most of your time as a sponsor or employer focusing on your business without the fear of liability and compliance as part of the equation. And in addition, going back to the individual participants and allowing them to save, these plans now have the ability to, and in the future will require, employers automatically enrolling employees. So you start with me after the waiting period, whether it be immediate, 3 months, 6 months, 1 year, you're automatically enrolled in the plan. You can opt out, but you're automatically enrolled. And not only that, you are automatically starting to take money out of your paycheck at a starting point. It could be 3%, 4%, 5%, whatever the plan design is. In essence, you're putting people in the plan. They can opt out if they want. They certainly can. But it's oftentimes doing that, you'll see an increase in participation. And some of the numbers are pretty amazing. Our panelist, Catherine, will go over that as well. And you'll see how these plans have increased participation substantially just by simply automatically enrolling people. So that alone, automatic enrollment and automatic contributions, are going to help point us in the right direction to help reverse the declining retirement savings rate. So with that said, our presenters today are going to discuss what the retirement plan industry has done in the past to try to provide better solutions, what current products are available, specifically with the MEPs and the PEPs and the passing of the Secure Act, and then a look into the future of what the eventual development of what we might call a 401k superstructure will look like and who's going to benefit from that. So with that said, if you have any questions during the presentation, if you could type them in the chat box, I'd appreciate that, and I'll try to get to those. But I want to introduce our panelists right now. So we have Troy Tissue, and in 2001, Troy founded TAG Resources to address the 401k product market gap in small business sector. Troy is a pioneer in the multiple employer industry, and the open MEPs and the 316 model, which is a fiduciary, administrative fiduciary model we'll talk about, 316. And many of the aggregated plan structures being offered throughout the country today were born from TAG's approach to these pooled structures. Troy is one of the industry's leading experts on both multiple employer plans and fiduciary outsourcing. He is regularly invited to Washington, D.C. to share his knowledge on the retirement industry with legislators and contributes to retirement-focused articles for a number of national publications. So thank you and welcome, Troy. Our next speaker is Jan DeServens. Jan is a public policy strategist, a thought leader, and consultant on retirement security and increasing longevity matters. Jan has gained a reputation for her skill in combining her subject matter expertise, strategic insight, and passionate advocacy to influence policy, legislation, and organizational priorities. Jan has led Transamerica's U.S. government affairs for over 20 years to setting up her own consulting practice in 19. And Jan has led the effort to open multiple employer plans and PEPs as a way of increasing retirement plan coverage under the Secure Act, which actually became law in 2019. And it continues, and she'll be providing us an update as well on Secure Act 2.0. So now we move on to our third panelist, Catherine Riley. And Catherine Riley is the Director of Retirement Plan Solutions at a company called Smart USA. And Catherine has over 20 years of experience working in the asset management and retirement industry in Europe and North America in roles that cover economic and investment research, product design, and business strategy. She is currently the Director of Retirement Plan Solutions at Smart, a leading retirement technology business and the world's largest record keeper, where she focuses on public policy, thought leadership, and strategy. Mostly, Catherine was head of the global research for the defined contribution team at State Street, where she oversaw a $70 billion State Street target date suite of investment funds, which I use quite often as well, and designed custom retirement saving solutions for domestic and global clients. She's also led strategic initiatives evaluating the impact of multiple employer plans, alternative investments, robo-advice, and the defined contribution business. So pretty good panel here, if I don't mind saying myself. A lot of information, a lot of knowledge, a lot of expertise. So we're going to talk to all three of the panelists, starting with Troy, then Jan and Catherine. We're going to kind of walk through where we're at, what's coming down the pipeline, and what is the future of technology and innovation as they coincide with our legislation. So with that, I would like to kick it off and have Troy introduce himself.
Great, thanks, Eric. So I'll share the screen real quick. Oh, wrong screen. You seeing the slides?
No.
No. Awesome.
Mm-hmm.
You're seeing a calendar probably?
It just says you have started sharing and it's blank.
we might have to have you share them, Eric. It shows it's sharing on my side, but if you're not seeing them.
All right, there we go.
Is it showing now?
Yes.
Okay. So we've got a lot to cover, and Eric, I really appreciate the introduction because you outlaid, in a pretty good way, the challenges that we face as a country in terms of, the three-legged stool that we've always talked about, which was Social Security, personal savings, and retirement plans. All are grossly underutilized and certainly underfunded. Social Security is its own nightmare that we could talk about for a day. Personal savings, as Eric laid out, are definitely underwhelming. And the defined contribution strategy in the United States, half Americans don't have access to a plan through their place of business. So we got a lot of work to do. And I think that you'll see there's a reason that multiple employer plans are kind of the darling of the industry right now. In many ways, they're kind of an overnight success that took 20 years to get to. But I want to start by saying this. There's a lot of wild enthusiasm around pooled employer plans today, multiple employer plans. And this is a quote from a movie I know all of you have probably seen or are familiar with. If you build it, they will come. As a proud, former Iowan, I love this movie and I love the premise of it. But having done this, built a structure like this, I can tell you this. If you build one of these in the anticipation of people flocking to it, that's not a great model. So learn from me. The best thing you can do if you're really entertaining getting in this space or joining a structure, make sure you have a client first. You need to build this for specific clients or situations. You don't build it just for a hunting license to hope people are going to flock to that structure. So that said, let's talk about, there we go, a brief history of where these structures came about or came from and where they're going. These are not new. They came about in their original kind of sense as a pooled structure back in 1918 when Andrew Carnegie created an endowment for teachers to keep them out of poverty. That was truly the original concept of pooling assets together for the purposes of retirement. We've had some stops along the way, like the 1947 Taft-Hartley Act was done, and that was a way for multi-employers to come up with solutions for unions. An important step in terms of giving some skeletal work for the framework that we use later. But the most important and significant change that happened that created multiple employer plans that are what we're going to talk about with PEPs happened in 2002 when the IRS gave a revenue procedure ruling to the PEO industry. It's important, and we're going to touch on PEOs. You don't need to know much after this call about them, but a PEO is a professional employer organization, much like a payroll company, that also does HR outsourcing and insurance outsourcing, benefit planning, a lot of things that a small business owner just doesn't have the skill or the time to deal with. And it's a great model. I've long been a fan of that model. And in fact, the very first clients the TAG had when we got in business in 2001 were PEOs. So we've been involved in the multiple employer plan kind of creation and evolution ever since, right alongside PEOs. That's all I'm really going to say about them, other than back in the day when we were doing all this work with PEOs, this was in the day of paper issued checks, if you remember that time, right? And all the great work we would do with all of these clients that were companies that worked with these PEOs, would it be for nothing if a payroll run was late and checks came in the mail, 2 days after they're supposed to, and we'd lose a client over it. So what we sought to do was figure out a way to use this structure, which was helping more people and getting more people in plans than ever before, but in a way that we could do that detached from the payroll shenanigans, right? And so we created the Open MEP, and that was in the fall of 2004. Very important move because that's what became the PEP. The Open MEP was just a way for unrelated employers to come together and get all the outsourcing that a PEO kind of delivered on in terms of enable a small business to offer a plan to their employees and really focus on the things that they did best, which was worry about their bottom line, worry about their company, take care of their employees, and know that someone behind the scenes was doing the work for them. So really too brief of an explanation of what happens next. In 2012, we actually went to the Department of Labor for clarity because there was so much enthusiasm around this model in the country. And through a whole series of events, the Open MEP was shut down. But as we all know, a good idea is really hard to suppress forever. But what it did was it created another concept. We at the time were using phrases that really didn't exist in the industry, like 316, 321, 338. A lot of the industry acronyms we use today, just in describing the outsourcing available, when you do a structure that's really created to outsource these things for a small business. And so all those things, really important evolutions in terms of our industry. And they do owe their origins back to the open MEP in those days. And I'm going to spend some time talking about the derivatives and kind of what led to the pooled employer plan here in the next slide. So the last thing I'll say is one of the things that we as an industry need to do is really focus on the coverage gap. And that means getting a lot of small businesses access to plans that traditionally haven't offered one. And that's going addressing the costs that Eric mentioned, where startup costs are way too cumbersome for a small business to want to do it. There's some great incentives that the Secure Act offers that Jen is going to cover, but making plan design a lot more easy to swallow in terms of really understanding it. I'm going to talk now just about the superstructures and kind of what these do, because I know Catherine's going to really talk about how they look when you do them correctly, and really utilize like modern record keeping approaches. But this is a pooled structure. There we go. This is a pooled structure of any kind. So if you leave with one thing that I kind of told you today, I'll be very, very happy if you leave with this. Every multiple employer plan, pooled employer plan, MEAP, exchange, concept, whatever you want to call them, synthetic MEPs, they all have this exact grid in common. And if you understand that, it doesn't matter what the crazy acronyms are that are placed in front of you, you'll understand how these structures work. Because the pivotal difference behind all of them is how you file a 5500. So again, all of them have a plan administrator serving as kind of the central part. You have the record keeper, you have the TPA, the auditor, the investment manager. All of these things are common to all. So then you have the specific acronyms. Well, multiple employer plans and association retirement plans, the MEPs and the ARPs, that's kind of like Coca-Cola and then the new Coke of the 1990s, right? A multiple employer plan and a ARP are created for related entities. So trade groups, associations, very specific groups that have a tie to each other. Where an open MEP or the modern pooled employer plan were created for unrelated employers, right? That's the pivotal difference. One's related, one's unrelated. But the thing that is the same for both is they have one 5500 and one audit. You go down to the group of plans concept that was also in the Secure Act. This exists today as an exchange. You'll see it marketed as the MEAP. What that is the exact same thing as a pooled employer plan in an open format with 5500s done by each plan. So same unrelated focus, but 5500s for all the small employers. And starting in January of 2022, we're able to specifically put large plan filers together on an aggregated 5500 with one audit. So it's a way to take advantage of all of these structures and get rid of the kind of reverse subsidy that can occur in a pooled employer plan, where a small employer is helping subsidize a larger employer's audit costs. Just like in the old days of the early multiple employer plans, you had larger plans that came in and helped subsidize the cost of the small plans. So we're finally to the point where these have evolved to the point where you can get the best of. But if you leave with nothing else, these on the right, this grid shows common aspects of any kind of pooled arrangement. And the question really becomes, what's best for your clients and for you in terms of a 5500 filing? That's how you can get very specific about what's best for you. The last thing I really want to touch on is we as an industry have done opinions of our clients. We like to tell people what they want. And it's evolved into basically the 3 Fs. And those 3 Fs have always been, this is what employers must want. We need to talk to them about the funds that are available to them. We need to really exhaustively talk about fees, and we need to tell them about the fiduciary risk. Well, that gets overdone and oversold, and obviously we all can live without yet another Excel sheet to go through, right? What really matters to an employer, as we all know, and I know many of you are on this call, is the day-to-day administrative relief. As Eric mentioned, in 2020, more than ever, you had to deal with remote employees and figuring out how you capitalize on all the resources you have available and shedding the things that you really just don't need to pay attention to and put a focus on. The benefit of multiple employer plans is the same as it always has been. You've got professionals that you're outsourcing to, and they handle the day-to-day. You know you have someone backing you so that it keeps you out of trouble. And it really puts the advisor in a position where they can actually help that employee do exactly what's needing to be done, as opposed to the typical advisor book of business where they have 20 record keepers they might work with, and they're war dialing to try to figure out someone that can help you with an answer. It's such a better model. It's the scalability, the fee structures, everything that it can do for people pales in comparison to the day-to-day stuff it takes away from you and it keeps you safe from and makes you more efficient at doing. So these are the structures. And if you really think that this is for you, or you're considering joining in this as a service provider or as an advisor, talking to your own clients, the last thing I want to leave you with is make sure that you spend the time finding the folks that understand this business, and don't ever mistake enthusiasm for expertise and experience, because there's wild enthusiasm out there in the marketplace today. You can't help but see a pooled employer plan kind of, stuff out there in the marketplace, but really spend the time figuring out who knows how to do this, and you'll win in the end. With that, I'm going to pass it to Jen. And after that, Catherine. And I can tell you that, as Eric mentioned, these are two of the pros in the industry. You've heard enough of me. I really want Jen to spend some time talking about all the tireless work that she won't give herself credit for, that made the Secure Act possible, but a lot of specific nuances about that I think you're going to benefit from. We certainly do as service providers in this industry, and there's great stuff ahead. So with that, I'm going to pass it on to Jen.
Great. Thank you so much, Troy, and thank you, Eric. Troy gave a great overview of the evolution of MEPs and PEPs and just practical considerations. I'm going to take a step back and provide perspective from policyholders, and hopefully through some of that explain some of the changes that took place, as well as help you understand changes are in the works and what may happen. When policyholders look at the savings gap that Eric mentioned and gave a lot of really good statistics, they look at it from two perspectives. One is coverage, how to get more employers to set up plan for their employees, how to help employees access these plans. And then the second is savings, how to increase the amount employees are saving in the plans. Eric, can you pull up the screen? Great, thanks. As Troy mentioned, there are a number of different ways that you can have this type of structure. The MEPs are, what has been around for a while. The plan sponsor is, Troy talked about the PEO, cooperative association. What the Secure Act did is to facilitate MEPs when Eric talked about, the concerns, administrative costs, liability. What Secure Act did was remove the one bad apple provision that said that if you're in a MEP, you as an employer and a MEP are liable for the acts or omissions of another employer in the MEP that may lead to disqualification of the entire MEP. And so even a lot of employers who are interested in MEPs would say, hey, I'm not going to be responsible for Joe Schmo and have, that upset the entire MEP. So that was tremendously significant. Then you go to the ARPs, or Association Retirement Plans, which as Troy mentioned, sort of like MEPs, the new MEP. This came about, and also not only does the industry have its own acronyms, but policymakers really like to have their own acronyms, which further confuses everything. But in 2018, when it looked like Secure Act and previous iterations of Secure Act were having trouble making it across the finish line for a number of reasons, totally unrelated to the substance of the bill, the president issued an executive order that specifically called on regulators to do what could be done to specifically expand access to MEPs, and especially address the concerns of the small employer and setting up MEPs or joining MEPs and in plans in terms of administrative complexity, et cetera. So DOL, Department of Labor, looked at this and said, okay, well, there is the requirement for MEPs to have this common nexus. We as a regulator don't think that we can unilaterally do away with common nexus. So we're going to just stretch it a little bit. Who can set up a plan, an ARP or this enhanced MEP is the same, but DOL then further defined what a PEO is, what an association is, basically that they have to have a purpose other than just running the MEP. And so by doing that, the DOL effectively said financial services companies cannot run a MEP or an ARP. The other thing that in the ARP, DOL said, okay, well, let's look at this common business nexus. And we will do away, we will say, yes, that's there, but we're going to add to it a geographic nexus. So for the first time, then a MEP could be, or an ARP could be run for tri-state employers, like the New York tri-state employers. U.S. local chambers of commerce have now started looking into setting up MEPs for its members in the geographic area. And then the final thing that DOL did in the ARP regulations was to confirm that working owners that can constitute themselves as sole proprietors could join a MEP. And that is actually one of the things that helped get, I think, the Secure Act over the finish line in terms of open employer plans. Is there's still, and still goes on, this discussion of gig employees, gig workers, and how can you provide benefits to gig workers that are outside this traditional employer-employee relationship. And when you looked at that and said, hey, this could be an avenue for gig workers, all of a sudden it became sexy and helped really push it over the finish line. PEPs are basically, again, because they had to have their own acronyms and changed a little bit, are open MEPs. The one thing that was added to this is the fact that since now there's no common nexus required, also anyone can serve as plan fiduciary for a PEP. So Congress said we're going to add some reporting requirements to that. And then finally, the aggregated plans, which I think Troy referred to as the multiple employer aggregated plans or group of plans, are not technically pooled plans because they still are a number of separate plans, but they are operated as a pool structure, and so achieve the administrative efficiencies, et cetera, from doing so. What Secure Act did is said that if you've got this structure, and specifically said if you've got the same administrator, named fiduciary, trustee, plan year, and investment lineup, then instead of, if you have an aggregated plan or pool plan or aggregate plan structure of 1,000 plans, you do not have to file 1,000 different Form 5500s, but starting with for plan year 2022, you can now file one consolidated Form 5500. Okay, next slide. So as I mentioned, for the pooled plan, the pooled employer plans, the pooled plan provider goes with it. So you don't have a pooled structure and then say, okay, who are we going to delegate fiduciary responsibility for running this plan? You've got a PEP, it comes with a pooled plan provider, and that could be any entity. So to help both employers figure out who this pooled plan provider is that is going to wield such authority over the PEP, as well as to really help DOL look at who is running this PEP and to monitor it. They have a lot of registration requirements, both before you set up a PEP, when there are any changes, you have to talk about the PEP structure and this reporting requirements. You have to name any service providers who are affiliates of the pooled plan provider. You have to name the chief compliance officer and also give the contact information for that chief compliance officer. So that really tells you the degree to which DOL is going to also use this as oversight, as well as provide information on lawsuits, both in terms of criminal proceedings, but as well as fraud. Next slide, please. Okay, so now we're turning to what, again, policy makers still look at coverage and what else can we do. They're going to be looking at what they put in place in Secure Act, but there are also a number of things in Secure Act that that didn't quite make its fully way across the finish line, that were left out and too late to add them back in. So earlier this year, I'm sorry, I'm actually going ahead of myself. I'm looking at the slide. And so the other Secure Act provisions that are actually relevant to what I've just talked about and that Catherine's going to touch on is the small employer startup credit. So Secure Act increased the startup credit for an employer entering into any plan for the purposes of its employees, from 500,000 to a maximum of 5,000 for each of 3 years. And that credit's up to 5,000, but it's 50% of the operating expenses. One snafu that happened, and that I'm going to talk about, that I started on, that happened just as the Secure Act was being enacted, is realization that the way the provision was drafted meant that the credit started from the time the plan was created. So if I'm an employer who's joining a MEP or a PEP in year 2 of the MEP or PEP's operation, I can only take advantage of that startup credit for years 2 and 3. So Secure Act 2, which I'll talk about, it says we got it, we realized that wasn't the intent, we're going to start it from the time the employer joins. Also, as Eric mentioned, you're now thinking about, okay, if you've saved enough, what do you do with these savings to help? How do you manage them through your lifetime? So with that in mind, and also in an effort to increase savings within these plans, the policymakers in Secure Act had the requirement of a lifetime income disclosure annually, taking the value of an account balance and having that portrayed in as guaranteed lifetime income starting at 65. There's a lot of controversy still about this provision and whether that's helpful or not. It's really geared to help people who think that 40,000 is more than they ever thought they could save, and wow, I'm doing a great job. To help people say, well, over a 30 plus year retirement, that's not going to be very much, and that's not probably going to even get you through the first 2 years. Then policymakers and Secure Act said, okay, well, we've done that, and we've alerted people to the fact they really need to start thinking about what retirement's going to look like, and how they're going to pay themselves in retirement. Also facilitated in-plan annuities by both providing that in the event of a service provider change, an in-plan annuity is no longer part of the plan's investment lineup, that a participant can take that annuity out of the plan without any penalties and roll it over to an IRA, as well as provide clear rules on when you put in an in-plan annuity, what you need to look like in terms of the plan provider. And then finally, just again, increasing access and coverage. Now, for the first time, there is a mandate that employer plans cover long-term part-time employees. So seasonal workers, maybe, a caregiver who's working and is only working, 30 hours per week instead of 40. Okay, next slide. Okay, this is where I actually skipped to, but this is both open matters in terms of Secure Act as well as what we can expect in the future. So we talked about Secure 2.0. I can't even remember what the name of the bill is because everyone just calls it Secure 2.0, and it was already being drafted before Secure was even enacted. Also in the Senate, you've got, this is on the House side, in the Senate you have Portman-Cardin and a whole host of other bills. and this bill was in Secure 2.0 was introduced in the fall. Secure 2.0, Portland Card and other bills will be reintroduced this Congress. It then expands, takes the concept of PEPs and open MEPs and says in the 403B space for the nonprofits, you can now have the same thing. It also fixes that startup credit snafu. It also clarifies or says that vesting in a pooled employer structure is related to the employer and not the plan. So under currently in the MEP, if I am an employee in employer one in the MEP, and then I move employment and I'm now employed by employer B, my vesting in that plan relates back to my first employer. So that will be corrected. And then it also requires as a way to increase coverage for all new plans to implement automatic enrollment. And I should also say that as part of Secure 2.0, it increases the startup credit further. Secure also has a additional credit of $500 for each of 3 years that automatic enrollment is implemented. In Secure, there is a provision that says if you have a MEP or PEP that's only small employers and defining small employers of less than 100 employees, and you've got less than 1,000 of those small employers in MEP, you can file a simplified Form 5500. We still haven't seen the rules on what that looks like. And then finally, fiduciary, and I'm not talking about fiduciary overall. That would take another webinar, but I'm talking specifically with respect to PEPs. Right after Secure Act, DOL was flooded with a lot of questions about, well, wow, if I'm now I'm a pooled plan provider, but I also have some of the funds that I offer as part of the investment lineup that's clearly a conflict of interest. How do I deal with that? And so DOL set out a request for information, said, is this something we should address? Comments from all over the place. I think the most compelling comment was that by Chairman Neal, the main architect and plan and sponsor of the Secure Act, who filed a letter saying, and I'm going to read this, conflicts of interest are inconsistent with the congressional intent of the Secure Act PEP structure, that pooled plan provider should not be the fiduciary responsible by overseeing itself and the provider investment products and services of the plan. So, and in a way, this is actually a moot issue because DOL, by the end of this administration, never got around to even issuing a proposed rule on this, nor do we think the Biden administration will have this issue anywhere near its top of its agenda, if at all on its agenda. So this is something that really should be looked into when setting up a MEP and whether there are conflicts. And that is it for my slide. Now I'm going to turn to Catherine to talk about what SMART is doing in this area and the UK experience.
Yeah. Thank you. Real quick, I know we might be running a little long. I don't want to take anything away from Catherine because this is the big finish. Please hang on with us as long as you possibly can. Again, I'm recording this. If you by chance have to jump out, let me know and I'd be happy to send you the recording. Do you want me to share your presentation, Catherine, or are you good on your end?
Let me check if I can get this working.
Okay.
I am trying. So are you seeing the screen now?
Seeing everything, yes, and including the slide deck on the left.
Okay, that's excellent. So now I'm just going to... So now are you seing anything apart from the slide deck?
Yes, we're good.
Okay, excellent. So I will try and keep my remarks to the point so that I don't keep you waiting for too long. But so I work for SMART, which is one of the world's largest providers of retirement technology. So we provide technology specifically for retirement saving systems. And in the UK, we operate our own master trust, which is the UK equivalent of a PEP, although actually the sort of governance outsourcing in a master trust goes even further than it does in a PEP. So basically, in a master trust, the employer can pass virtually all of its responsibility off onto the master trust. And I'm going to tell you a little bit about the UK experience because I think it informs how we might see the PEP market developing in the US over the next years. And also tell you a little bit about the capabilities that Smart is bringing because we are entering the US market specifically as PEP starts to take off here. So how did master trusts take off in the UK? Master trusts have actually been around for several decades, but they existed, but they were not widely used. However, as Eric was mentioning earlier, you know, retirement coverage is a problem, retirement savings are a problem. If you can believe it, they were even more of a problem in the UK. So in the UK, the state pension, the equivalent of Social Security, is much less generous than in the US. And also, coverage rates in 2012 were only about 40% of private sector employees had access to a retirement plan. So in 2012, the UK government introduced a mandate, which meant that all employers had to offer their employees a plan and automatically enroll them into the retirement plan. And employees had the option to opt out, but they had to first be automatically enrolled. And this was introduced over a period of several years. So they started out in 2012 with the very largest employers, and by 2018, they had covered all the employers. And I'm not sure if you can see where this graph ends, because at least where I am seeing the pictures, they're right over it. But basically, from a starting point of 40% coverage in 2012, by 2018, 88% of private sector employees were covered by a retirement plan. So spectacular increase in coverage. And a very nice feature is that this was across the board. So even groups that typically tend to not be covered, such as people under the age of 30, people on very low earnings, people who are only working part-time, people who work for small employers, you saw virtually the same change across all the groups. So basically the young, the low earners, the part-time workers, coverage among those groups is, if it's not 88%, it's 85%. So it is basically at the same level as the market overall. And those who work for small employers, this is still somewhat lower than it was previously, but it started off at about 15% and went up to close to 60%. So very strong increase in coverage. Now, of course, this changed the retirement market because the providers who were in the market before automatic enrollment, they typically catered to the large employers that did offer retirement plans. And automatic enrollment meant that you had a lot of employers entering the market for the first time. They hadn't offered retirement plans before. Often the people that they were employing were the people who tended to be at the lower end of the earnings spectrum. So these were employers that were not traditionally very attractive to the traditional retirement plan providers. The government established NEST, which is a sort of government-run master trust, and the idea was that NEST would provide every employer who wanted to use NEST with a plan, and it would not charge the employer anything. And this was so that no one could say, well, I tried to enroll my employees, but no one would have me, or that they were going to charge me $5,000 and it was going to put me out of business. But with the benefit of hindsight, you would not necessarily have needed NEST. Smart, for example, was established in 2014 specifically for the automatic enrollment market. And it is a purely commercially based solution that relies on sophisticated modern technology to be able to service these small accounts in a way that is profitable. So here we see in the Smart Pension Master Trust, 88% of our employers have fewer than 10 employees. And if we look at the account balances, almost half of the balances on our platform at the moment are below £1,000, which would be $1,300. So through the use of technology, it is possible to service these very small accounts and still do it on a basis that is sort of feasible from a business perspective. And I want to talk a little bit more about the way that Smart employs technology. So I think there are two key areas that are interesting. And disclaimer, I am an investments person, not a technology person. So if anyone asks me complicated questions about API, I will not be able to answer them. But the way I see it is you have two innovations. You have platform technology, which is how the platform itself is designed. And then you have the user experience, which is how people, employers, participants, advisors interact with the platform and how they are able to input information and receive information. And on the platform technology side, most record-keeping platforms, at least the ones provided by the large players, they are legacy platforms. Obviously, they were initially designed 30 years ago, and then of course they have been upgraded multiple times, but they tend to have various systems that have to interface and mostly are based pretty much on servers. They have different layers of technology, and this all makes them very difficult to upgrade, and particularly as the needs of the retirement plan have changed so much. The 401k system was initially designed to be a supplementary plan, whereas now it is the primary savings vehicle for most people. And also there is increasing pressure to extend the 401k plan to also encompass the retirement phase. This is something that current record-keeping platforms are not designed to do. The Smart platform is one global platform, and it's modern technology, so it's purpose-built for the defined contribution plan of now and what we expect to happen over the next 10 to 15 years. It has API connectivity, which means that service providers can connect directly into the plan without all sorts of middleware solutions. It's completely cloud-based, which means it can scale up immediately. We don't have to scramble around finding new servers to expand capacity. And one part that I'm very excited about as an investment person myself is the fact that we have a platform that manages the accumulation, the savings phase, and we also have a separate platform for the decumulation phase. So using this, you could keep the participants within the same plan while they're saving for retirement, and then through the decumulation phase, through retirement, you could also continue to keep them in the plan without them having to necessarily roll out into an IRA or some separate solution for the retirement phase. And this makes it possible to host some of these very interesting investment products that have been designed to take people through to retirement. From the user experience perspective, it's designed to be digital, making it, that is a key part of making it low cost to service large numbers of small balances, is that people have to be able to use it on a self-service basis. So it has very simple user interfaces for the employer, for when they set up a plan, for the participant, for when they interact with a plan. Like Eric, you were saying earlier about what about when participants want to change their contribution rates? Well, they just go onto the Smart platform and do it. The employer doesn't have to worry about it at all. And it also has a simple interface that an advisor can use when they're working with a client and helping them to set up one of these plans. The employer can set the plan up directly if they want to, and actually during the automatic enrollment phase, that's what we mostly saw, employers interacting directly. But now in the steady state, we see more use of advisors. And we find that in the UK, it's possible to set the plan up for an employer in about 30 minutes. So it is a very quick, painless process. There's a lot of automation, bringing in documents from databases, etc. And just a very brief final word on how the market has panned out in the UK. You have primarily three different types of master trusts. You have automatic enrollment trusts, which cater to the low end of the market, and you have consultant-driven trusts, which are like Aon, Mercer, and then you also have the provider-led trust. So for example, Fidelity has its own master trust in the UK. The governance structure there is such that financial services providers are able to have their own trusts because they have a separate independent board of trustees overseeing them. And like I said, initially we saw a lot more employers going directly to the trust. Now we do see a lot more use of advisors, particularly when they are deciding between which trust to use, they typically rely on advisors or consultants to do due diligence so that they can verify that they have selected an appropriate trust. And as I know we are running up on time, I will end here and I'm open to any questions that you may have. Thank you very much.
All right. Thank you, Catherine. That was awesome. I really hope everybody got a little something. It was a lot of information. I think I could have done 3 webinars based on that, but this primes a pump. There's still a lot of work to do in the direction of changing retirement savings in this country. I think we're at the beginning of a long trend towards affordable and easy retirement plan options. And that's only good for employers, it's good for employees, and I really think it's best for the future of the country, where people have a little bit more flexibility with their own retirement savings. So personally, I'd like to educate as many people as possible about the current and future opportunities for retirement plan savings. So if any of the participants on the call here today have an opportunity and know organizations that would benefit from being updated on PEPs and MEPs and current alternatives in the future, I think business owner groups, CPA, CFO, HR organizations, I'm very happy to volunteer my time and come in and educate, either groups of people or individual plan sponsors. Along with that, I'm happy to offer a free benchmark report for the plan fees so that you know where the plan stands from a fee point of view versus your peers. And I think just as important with that, I can do a total compliance review of the internal administration procedures to uncover any potential liability. So I appreciate that. If there's an opportunity to let me know. And meanwhile, keep an eye out for future webinars and updates on the PEP market as it continues to develop. I'm sorry I didn't have a chance to get to anybody's questions, but feel free to follow up with me afterwards. I'd like to thank the attendees for joining. I appreciate the time. And a special thanks to my esteemed panel. So I wish everybody a great day. Thanks again for your time. Okay, take care, everybody.
Thank you.
Thank you.